Hello and welcome to this video. In this video, we're going to assume that you've just had an email from your accountant and you're about to go and sign your set of accounts. Now, before you sign those accounts, watch this video to make sure you know exactly what those accounts mean and also some tips to look out for as well. Hello and welcome to this video. My name's Aaron Patrick. I'm a Chartered Accountant, Certified UK Trainer and also that QuickBooks Chap. As my role as Head of Accounts at Boffix, one of my roles is to make sure that when we send stuff out to clients to get signed, that they're correct before they get signed. And as an accountant, we pride ourselves on making sure that what gets sent out is correct, so that before you actually have to put your signed signature to it, you have confidence that those figures are as good as they can be. But that doesn't mean that you shouldn't understand exactly what it is you're signing and why you're signing them and what's the benefit of making sure that you can actually see that you're confident in those figures and those figures are as you expect them to be. So join me on this video where we look at a set of accounts that we need to sign. We explain exactly what it is we're signing. We look at what it is we're looking out for, and then we utilize that before we go and finally make that signature. Now in this video, we're going to concentrate on a limited company. We're just going to concentrate on the accounts for that one. When it comes to their tax return and making sure that's correct, we're going to cover that in a different video. But for this one, we want to make sure that you're fully understanding what it is you're signing, why you're signing it, and also how those figures came there in the first place. And that's a great place to start. Where did those figures come from? Where did these figures come from that appear all over these financial statements? Well, that question is going to vary from business to business and from accountant to accountant. But at the end of the day, they must be some form of prime records that gives you the ability to pass information over to your accountant for them to then create a set of accounts. And as a director and owner of a business, it's your responsibility to make sure that you give everything over to the accountant. So before you go any further, just make sure, before you even look at the account, have you sent everything to them? So that could be that, have you sent all the bank statements? Have you sent anything to do with cash expenses? If you've had any capital expenditure or you've sold any capital items that's outside of your normal bank account, have you told your accountant about them? If you're using a form of software like QuickBooks, are you happy that everything's up to date on there? Everything's been included so that your accountant can access all the information they need? If you've got Excel or if you're using a cash book, have you made sure you've sent the correct version, the correct up-to-date one? Just do a little sense check to make sure that they have everything they need to be able to complete that set of accounts. Now, it shouldn't have got to the point that you are signing your accounts at that point, but it's always a good sense check before you even open that, just to make sure that you've done your responsibility and sent them over. On the other side, the accountant may have had to make assumptions. They may have had to make good guesses based on their relationship with you, what they know from the past, other information they may have held, or they may have pieced together a decision based on the information that they've got in that particular year. And assumptions are so important. So if they are sending you a set of accounts, just have a look at the covering letter or the covering email, or maybe a conversation you've had with them, and just make sure you're happy with the assumptions they've made. Most of the time they're going to be absolutely spot on, but you might want to just make sure that the assumptions you've made are something that you would be able to agree with as well. So if they're assuming that 20% of your costs of your travel expenses was actually personal, you need to be able to justify that. Because if you ever get asked to confirm it, if you ever get asked to look at it in any way, you're the one who's going to have to be able to be responsible for those assumptions that's made, even though it's your accountant that's made those assumptions. Because when you sign those accounts, you're signing those accounts based on all the information you've handed over to the accountant, and you're agreeing on any assumptions that accountant may have made on your behalf as well. So make sure you understand those accountants' assumptions, and if not, just ask them and talk to them about it, and then make sure that you were both in agreement. So if you've handed over all your information to the client, to the accountant and you're happy with the assumptions they made, then we're at a point where these set of accounts should be correct. But that doesn't mean we just sign them without even looking at them. Let's have a look at what we're signing, why we're signing them, and what they actually mean. So let's have a look now and see what a set of accounts actually represents for your business. Now, the way these accounts can be sent to us can be various in terms of the way in which we can look at the information or be presented the information. So maybe we've been given the opportunity to look at them electronically like we have here, and then Adobe sign, DocuSign, however it is they're asking you to sign it. Or maybe you've had a paper copy that's been sent through the post, or you've been asked to fill them in manually in a meeting. Either way, the data you've been given will be the same, it's just that it'll be in different format. So you get two sets of accounts. Now the thing that we're going to look at today and concentrate on today is those full sets. Remember that the fact that the abbreviated set will be exactly the same data, it's just taking out some of that of the sensitive information. But let's concentrate on the full set of accounts that we've got in front of us. First of all, it's going to tell you your registered number, it's going to tell you your name, and this is your front page. This is giving you some information. The key thing to think about here though is your start date and end date. The start date and end date will always be in the past, and it's always really important to remember that for your mindset, when you're thinking about these set of accounts, you want to be thinking about the fact that there is something that was happening in the past. So irrelevant to a point is what's happening exactly now. So if you're having a really good business time, or it's really reduced, or whatever it's going to be, that's fine, and that is going to have some bearing in the account. But for what you're actually about signing off is about that particular period. Now we do what's called accrual accounting for accounts in a limited company. And what that means is basically we're not just taking into account what happened between the 1st of April to the 31st of March. We're going to be looking to see what else happens either side of those dates which can affect this set of accounts. So you will see some adjustments for stuff that's happened before and after, but majority of the time you're going to be concentrating on that particular period. So set your expectations. Was it a good year? Was it a bad year? How did you feel like those accounts went before you go in and look at signing them? Use that feeling, use what you expect to see to form a basis of if you're feeling confident of what the figures are saying or not saying. Now, either you're completely right and there's something wrong with the account, or you've not been able to look at it in the correct way and that the accounts are actually showing the true reflection. None of those are wrong or right or whichever's thing, but at least if you set your expectation beforehand, one way or another, you're going to feel either confident with the figures or less confident and need to ask the questions that are going to make you more confident. So set your expectation first and then move on. So with QBO case studies just here, we're moving down and then we get to our contents page. And all these items here we're going to look at in more detail as we go through. But effectively it's telling you what number to look out for the company information, director report, accountant report and so on. Now we start getting to the main part of the actual set of financial statements. This is your company information for the period ended that we've just talked about, and the first thing it's going to tell you is which directors are there. So in this case we've got Aaron Patrick, the QuickBooks Chap. Then it's got registered number, really important because that's what gives you connect between here and also what's happened on company's house. Registered office is where your registered office is for this particular business, and then most of the time you're going to have your accountants there as well. The next one is your director's report. Now the director's report is effectively aimed at you. So with a director's report, this is telling you basically what your responsibilities were and also what the activity was at the business. And the idea of it, especially for bigger organizations, is to give kind of a context of what's happened within that period. So normally a director's report is a place where a director is going to explain to the board members good things, bad things, whatever's happened, what they should expect in this statement and what they should expect in the future, and give some context of what's happened. For a small business, we don't need to go into that full amount of detail. We do need to say what our principal activity was. So on the director's report, you're going to have principal activity. So this principal activity is all about teaching small businesses information one video at a time, with our goal of helping small business not just survive but to thrive. It's telling you who was the directors during that period, and also it's going to give you some statement director's responsibilities. And it's that statement of responsibilities that's probably the most important bit, because you're being asked to sign this area just here, and one of those signatures is basically you saying you're happy you've confidently kept your statement of director's responsibilities. So you've made sure that your records were available. You've made sure they give a true and fair view of the affairs. You're making sure that the accounts that you're going through now fairly represent how the business is going. And you're making sure that they're on a going concern basis. And it's going concern basis, which is really important. The idea of going concern is that your business is going to continue in the future, so that there's no reason why people shouldn't have any confidence in being able to take business from you or be able to lend you money or whatever that conversation needs to be, you need to be putting that as a going concern basis. That's your director's responsibility. The next one is your accountant's report. Now, depending on what type of accountants you have, depends on how this report is going. For us at Boffix, we're ICAW, so that means we have to do our accountant report based on ICAW and how ICAW wanted out to be. So that's Institute of Chartered Accountant England and Wales. And basically that's us having to sign to say we're happy that everything is okay in these accounts. And the most important thing we're going to be looking at is that balance sheet that we're going to look at in a moment. So when we're signing it, we're really making sure the balance sheet's absolutely spot on. That's our biggest priority. To you as a small business owner, really your biggest priority is going to be your profit and loss account and how that works and what money you've got in, what money you've got out, and more importantly to most, what tax you may have to pay. But for us as accountants, we're really going to be honing on that balance sheet. We want to make sure that balance sheet's absolutely spot on. The next one is your first income statement. Now, depending on how your accounts are generated, what you normally find is this is kind of your smaller version of the income statement. This is just your standard income statement, but later in the accounts, normally at the end of your account, you'll find your detailed income statement. And when we get to the detailed one, I'm going to talk about it in a lot more detail. There's no point me going over this to then having to go through it again in more detail. And I'd highly recommend that you always just concentrate on that detailed one and also request the detailed one if you don't have one as part of your financial statements. And then one of the big ones, statement of financial position. Statement of financial position, or your balance sheet as it's commonly referred to, is the most important part of the financial statement for us as accountants. This is the bit where we spend our time making sure it's absolutely spot on. This is where we need to get confidence that whatever's shown on that financial statement, we can actually agree to in the real world. So if you've got a bank figure on there, for example, we want to be able to see that that bank figure exists, there's a statement, and we've got to the right figure so that we're balancing to the penny of what it needs to be. I'm going to go through that financial statement now and understand and let you know what each element means, keeping in the back of your mind that, number one, as an accountant, we need to make sure we reconcile that and we can understand how that figure is and we can basically sign it off to say it's correct. And number two, you need to understand of how we've got to that position, how that is and what that affects your business going forward. So let's have a look at this financial statement and make sure we're happy with it. So your financial position. Look at that key date there, 31st of March 2019, and note it says as at. As at because it's actually on that particular day. Every other statement that we look at in here is all looking at the period, so between what the start and at the end. The financial statement, on the other hand, is always a line in the sand. It's as at a particular day. So it's really important that you understand that when we look at this and when we look into exactly how this works, you're looking at what date this represents. In this case, 31st of March 2019. And the subsequent year, so if you have a prior year, which is always useful to do your comparatives to, will always be the statement of that particular period, whenever that last one was. Normally 12 months, but sometimes, depending on if you have like an extended or a reduced year of your account, you may find that that period was slightly different, but you should see that being represented there. In this case though, this is 31st of March 2018, this is 31st of March 2019, which is the one we're looking at now. These have already been signed off, so we should have confidence in these, and these should be what we're signing off this year. One thing to note though, this year is really critical to us because that's our starting position. So at 31st of March 2018, that was the figure we had, and then the next day we should pretty much have the same figure unless there's been major changes. So this will be a really important figure because we've basically moved from this position to this position in that financial period. So in this case, 12 months. So let's cut this down into the sections that we're interested in. First of all, we have what's called our net assets just here, and then we have our shareholder funds just here. And you'll notice they're the same, and that's true. They have to be the same. For a set of financial statements to agree and to actually work, your net assets must equal your shareholder funds. But what do they mean? So your net assets basically are an example of exactly what your company was worth on paper at that point. Your shareholder funds, or your capital and reserves, is basically what's owed to anyone who owns that company. Remember that in a typical limited company status, your owners are the shareholders. So whoever's actually bought the shares at that point. And that money, that pot of money that the company's generated, is owed to the shareholders, and it needs to be distributed to them. But before it can be distributed, we need to know, well, what's capital versus what's actually available to be passed out in reserves. We can look at that in more detail, but the net asset and the capital reserves have to agree, otherwise your financial statements won't agree at all and they won't actually be working. So first thing is to make sure those two figures agree. If those two figures agree, then we know the accounts are in good shape. Now we just need to understand the smaller details of how that figure was got there in the first place. So what you'll normally find is that the financial statement, the net asset area, which is basically what your business is worth on paper. And remember, this is on paper, this isn't realistic. But if you're going to add up everything your company owes and owns compared to what it actually needs to pay out, then that should give you a position of what's left over. If you're going to sell at that point, if that was it, gave up and that company was just going to be jettisoned at that point in time, then it should be all the assets it owns, so it's computers, it's chairs, it's everything else it has, all the money in its bank, all the debts that it might need to bring in, so any debtors it needs to owe, and then less anything it still owes, so any taxes it needs to pay or other creditors. That final figure should represent how much that company is worth on paper. Therefore, if you were going to just sell up at that point, that's how much money you should get at that point. So it should represent everything that you actually own, like all of those assets and all of those money, less anything that you owe to other people. So what is it you own? Well, first of all, it's your tangible fixed assets. And it's notice this little number here, this number 6. That there represents that later in the account is a much more detailed note of what this number represents. At this point, this number doesn't really mean much to me. When I look at number 6 later down the line, we'll see that it's broken down into stuff that I can actually understand and make use of. What tangible fixed assets is? Well, that's all your big equipment, your big assets that you own. It could be anything from mobile phones, iPads, computers, to machinery, to cars, to vans, to all the big assets. And the idea of an asset is something that you're going to pay up front for a significant amount of money, but it's going to last for multiple years. So instead of just having it as one cost in the first year that you buy it, we spread that item over the life of however long it lasts for. So you're not just having to see a profit and loss account get hit really hard in the first year that you buy something, you're then going to spread the cost over it however long it's going to be. And that should be a more fair representation of you buying that asset, instead of just having maybe a loss in that first year and then massive profits afterwards. So we want to spread the cost of it as we go along. Hence why we put it in as what's called a tangible fixed asset. And then what we do with these fixed assets is we charge what's called depreciation. You're going to see depreciation later. And that depreciation is basically going, well, let's spread that cost over how long we think that asset's going to live for. Stocks could be anything that you hold, you physically hold in your inventory that you haven't yet sold. So it could be anything from you're a manufacturer and you build things up and you've not quite got to the point where they're ready to be sold yet, so you want to put a stock figure then. You may also have other stock items that you have sold. If you're a service company, you might have some work that you've done but you've not quite billed for, so we call that work in progress. Stocks are basically a figure where we're going, right, we've done some work in a particular year, but we've not quite actually received the income for it, or we've not sold that particular transaction yet. All of those transactions we want to class as stock. And stock's really important to us as a business because stocks show us what we can start to expect and we can start to build on in the next financial year. Debtors. In a nutshell, that's how much you are owed as a business. So that's people who have yet to physically pay you for something that's coming forward. So you'll see again, when we look into that note, we'll see again what that represents and how that is. Cash at bank in hand, that's how much money you've got in cash reserves at that point. And it could be anything from your bank account to maybe a savings account to a cash tin to money in your tills. It's all of those different items all added together into a form of cash at bank in hand. And again, depending on if you have more detail or not, you may have a note later down in the account which tells you how that's broken down. But you should be able to fit, that's one of the figures that you should definitely be able to agree with. Cash at bank in hand is probably the easiest one that you can understand because that's the figure that you should have told your accountant and you should show in your financial bookkeeping. So the bookkeeping you do, again, if it's on Excel or if it's on QuickBooks, doesn't matter what it's on, but you should be able to tell them what your final figure should be. And also you should be able to go to your bank statement and be able to get roughly to that figure. It might be consistent of multiple amounts, so you might need to find the detail as to exactly what's included there, but you should be able to go and say, yes, I agree that that's how much money I had in my bank at that point in time, because that's fact. That's on a bank statement. So you should be able to agree on that. And as an accountant, this is the one where we really have to get right. There's no excuses for it. We need to make sure that our bank accounts agree with our bank statements, and we need to agree that, say, if there is a cash account, well, does it look reasonable? If it's negative, it's definitely not reasonable. There's no way you can have negative cash in a cash tin. Also, if it's massively overflated, it also wouldn't be reasonable, because you would at some point would have taken that money out and put it into a bank account. So we need to make sure these figures are right. So cash in hand is a huge one to concentrate on and understand. After that, it looks at its current assets, it adds them all together for us, and then starts thinking about the other side of things. So how much creditors do we have? Again, note 9, when we come to it, will show us in more detail, but this is money we owe. So we can't do a set of accounts with also thinking about what we also owe as well. So this is important to us to understand and look at in a lot of detail and make sure we're confident with. Because if we were going to sell up at that point, then yes, we can get all our debtors in, we can sell on any stocks items we've got, we can look at the cash in bank, and we can look at our tangible assets and maybe sell them on as well. But none of that will be relevant to us unless we also clear any debts that we have with other people. And that's what the creditors figure is designed. It then takes into account what we call our total current assets and current liabilities, and we call that our net current assets. So that's something that really quickly, in a flick of a switch, we should be able to liquidate that and receive that cash for that amount. So in principle, that should be all of it all added together quite easily for us. Then we need to consider, well, what is other items that might be a little bit longer? We might have to wait a year or 2 or 3 years before we can actually realise that money. And that's where we have extra assets or extra liabilities, where we're going to strip out of the normal current assets and current liabilities, and we're going to treat them as more long term. So that if we were, worst case scenario, having to sell up, we can pretty much rely in theory on this money coming to us really quickly, but then any adjustments down here is stuff that's going to take longer for it to materialise. So we want to split them so that we can be fair on people when it says, well, if we were going to sell up tomorrow, what sort of cash would we have? And that gives us our net asset figure. Now, one of the key things about a net asset figure is its liquidity. And one of the things your accountant will always talk to you about, or should talk to you about, is solvency. So is your account solvent or not solvent? And basically what that means is, can your account sustain the amount of debt that it's got? So we saw there's those creditors that it owes. So it could be the tax man, it could be other creditors, it could be loans, it could be all manner of different elements that could result into being that creditor. Now, with those amounts of creditors that there's there, you as a business need to make sure, or you should be showing, that doesn't matter what that creditor figure is, you've got enough cash in the bank, or you've got enough debtors coming in, or enough stock to sell, or enough assets that you can sell off, that you can actually achieve to pay those particular amounts. And that's where it gets really critical. We, as a business owner, we always strive to have that positive net asset figure. We don't want to be classed as insolvent as we can help it, because an insolvent company is going to cause us issues down the line in terms of borrowing, and we're also going to have a big concern over our head about that whole going concern issue, because going concern is that you're confident that next year you're still going to be around and you're still going to have a business. If you're in a solvent position and all those creditors start wanting to have payment now, well, what have you got in your back pocket to be able to make sure you can make those payments? So being in a solvent position is quite a crucial bit for small businesses, and something that as business advisors we try and make sure as best we possibly can that we make sure our businesses, or the people we're looking after, are in that position. So we've got our net asset figure, and again, that figure in reality is if you were going to sell up today and you're going to sell all your stocks, sell all your assets, have that money in your bank, look at all the debts and pay all your creditors, that should be what's left over. And if that's what's left over, then that's how much is then due to all your shareholders. And this is then what happens with your shareholder funds. So the idea then is that you've got all of these funds that are available to your shareholders. And because remember, the shareholders own your business, then it's their money. Now, if it's just you as a single business owner, that's really straightforward. That money is yours to take out at whatever point you need. But if you've got multiple shareholders, multiple shares, different share structures. It can be a little bit more complicated about who owns that exactly, but the idea is you should be able to say, well, that's the amount of money that's left over, and that's what's designed for that business. And then we split that money into what we call capital versus your normal reserves. Now, capital is basically how much they've paid for an individual item. So if they've paid £1 for a share, then that's what they've actually been able to capitally have as ownership of that company. And again, you can have multiple shareholders who've bought multiple shares, but the idea is that that capital element is then put together at one side because that's your capital estimate of it. And then we have what we call our profit and loss, and that, or your reserves, and that's basically how much money your business has left over to pay dividends. Now, one thing to note is that profit and loss figure will not represent how much money is typically available as cash. How much cash reserves you have available versus how much profit and loss or reserves you have available is two different things. Your reserves is the ability for you to pay dividends, so be able to reward your shareholders for being able to put that investment into your company. Because remember, you asking the shareholder to invest in your business, your return is either going to be that their shares are going to massively increase in value and they can sell them off later, or you're going to be paying them dividends, or a mixture of both. So the idea is that you want to be rewarding your dividends. And as a shareholder and a single shareholder, it's even more important because normally those dividends is what means that you can actually pay your mortgages and everything else that goes with it. So having a good reserve figure is really important to you so that you can then pay out dividends and reward either yourself or fellow shareholders. But that doesn't mean that just because, and here we've got £118,000 of reserve, doesn't mean that we can just straight away pay £118 worth of dividends. We need to make sure we've got enough cash available. And let's have a look again about what that figure represents. So it's £118.72, which is £100 less what's here because of those shares. But remember, we have £186,854 in our bank. So in theory, you'd expect to be able to pay that figure, but we've got 200k worth of creditors there as well. So we need to make sure that before we pay that we've got enough money coming in to be able to pay off those creditors. And that's what we need to make sure. We need to make sure that these stocks are going to get sold in good time, that these debtors are going to come true, and that if we did pay out all our shares as dividends now, that we would have enough to cover the creditors that fall due as and when they fall due. Because as a director, and one of your responsibilities is to run a business that is actually being run properly. And one of those and being run properly and true and fair means that you're prioritizing the right stakeholders. So a normal creditor would normally hold more weight and be a more bigger priority than your shareholders, because shareholders should be after everything has actually happened in a business. So if you're showing that you're paying your dividends out first to shareholders and not paying your creditors, then you may find yourself in a bit of bother there. So make sure that you understand that, yes, okay, I've got X amount as reserves, but have I got enough cash available to be able to pay those reserves out? Is my cash flow sufficient for me to be able to make that dividend payment? The next thing is for you as a director to go in and make sure that you're happy that that financial statement is correct. So again, you're looking at, have you provided all the right information? And also, is that information shown in the accounts properly? So you're basically going through, looking at your director's responsibility, see if you required an audit or not. Now, an audit is something that is for much bigger companies, so majority of the time you won't have an issue with that. And I advise for most small companies to even go down the audit route because it's just cost that isn't going to be relevant to you. Then you've got the director's acknowledgement of their responsibilities. So again, looking back at that director's responsibility back at the top, and then finally you're asked to sign that you're approved and you're happy with it. You'll also be told here what regime these were signed off for, and it just gives you those sort of confidence into what's going on. Your next part is then basically talking about your notes to financial position. So how did your accountant get to those figures? And basically in here, you should be able to see how they've got to each one. So exactly here, it's telling me my basis of preparation, how it was basically created, how my turnover was measured, how my foreign currencies were dealt with, how deferred taxation was included. And basically each one of these statements here is about telling you how each one was done so that you can then have confidence, and other stakeholders or people who are going to use the accounts are going to see and be able to understand. So always just make sure you're happy and confident with what's going through there. One of the big ones is when we look at your tangible fixed asset, what position or what percentage have we put your capital items to? So if you're putting your motor vehicles, at this point it's 25% reducing balance, well, does that feel right to you? You know, the idea here is that in basically 4 years, or reducing balance means it could be indefinitely, but majority of it will be gone in 4 years' time. Is that how you expect for your assets to be? Computer and fixtures, we're saying here computer equipment free. Well, you expect that to be quicker because the rate at which technology changes and the rate at which items become obsolete is probably quicker on a computer asset than it is on a motor vehicle. So it's things like that that you're making sure you're comfortable with. The rest of the notes, as I said before, is all about diving deeper into those sort of activities. So we talked about how note 6 was going to show us our tangible fixed asset in much more detail, and that's exactly what it's done here. It split that figure that we saw, £11,074, and then it's split between motor, fixtures and computer, and then we can see how they are. So in this case we've had £1,200 worth of additions, so make sure you're confident that you remember seeing that and that feels right. Or you're thinking to yourself, well, I bought a new asset, why is that not there? Also keep an eye on this disposal figure here. That's going to tell you if anything's been sold in a year. The charge for the year, that's what depreciation we've done, and that's that whole aspect of going, right, we're going to take the asset and we're going to spread it over a number of years. So in this case, this particular asset, we've already had 1,677, which was done in the last year, of the original 11,500. We're now doing 2,875. So that's how much has been charged so far. And the difference between the two, which is your closing balance here, is what's still to be charged. So that's what's still to be shown in your profit and loss account. So up until this date, although you've had this asset for 2 years in this case, you've only actually recorded almost £4,000, maybe £5,000, £4,500 worth of the cost, and there was 11,500. So there's still £7,000 still to be charged over the next couple of years, and that could take 10 years or so on a reducing balance method. So be aware that feel confident and comfortable in what that's saying you. That's basically saying that asset, you're still using that asset, and you should still be using that asset. So you bought this asset 2 years ago, and if you're going to be using it for the next 5 or 6 years, then you want to be showing that cost in the business in 5 or 6 years' time. Stocks. Now this could be what is actually there. Now to me, when you see a round some figure like that, that means that it's an estimate. So you've got to see, go back to your assumptions, have a look, are you confident that that estimate's right? On this one here, it looked like we had some sort of stock take that was able to give us an accurate representation of it, and on here we weren't. So make sure you're happy. When you're signing those set of accounts, you're signing to say that you're happy that that estimate was correct. So make sure you've looked into that estimate and you agree with what that estimate was. Then we're looking at debtors. So this is breaking down what that debtors figure was that was on our financial statement, was on our balance sheet, and just showing you how that was split. So in this case, 10,100 was to do with your trade debtors in this case, and £10,000 was other debtors. I would always question what those other debtors are, just to make sure you're happy with what they're representing. From this point, it looked like it was in last year as well, so it's something that's been carried forward one year to the next. So just make sure you're comfortable and happy with it. The trade debtors though, you should have an idea if that's correct or not, because you should know if people were owing you money at that point, and then what the likelihood of them being paid. One thing I would also ask people to look at there is any of that debt actually bad at this point? Did we have some money included in that trade debtors which we still haven't received and we're considering writing off? If that's the case, then let your accountant know, because they can actually reduce that trade debtors figure and put in what's called a bad debt provision for you. Then we move on to the creditors, and again, that almost 200k figure was what was shown in the accounts. So that was what was shown in the account, and it was broken down to all of these figures here. And this is where you can then start understanding exactly where those figures came from. So we had a VAT man was owed £21,000. We had our director's current account. Now there'll be another video about director's current account coming soon, but effectively that's how much is owed to you as a director. So that's a good thing that it's a creditor. We want it to be in that position, and basically that's, in a real nutshell, but do refer back to that other video, that's basically how much money is owed to you without you having to pay any additional taxes. There's an accrued expense. There's a PAYE, so that's how much you're owed to the payroll, owed to HMRC regarding your payroll taxes. Trade creditors, we might even see a tax position in here for corporation tax as well, depending on how much may be owed or not. And then on this one, the reason it's so big is amount owed to group undertaking. So in this case, there must be some sort of group structure in the business. So we've got amount of money that's owed from those groups. And that's basically what we want to make sure we're happy with at this point. Confident that that's the sort of thing. Now, these should be quite straightforward. We should just be able to look at that particular set of accounts and the opposite figure should be showing so we can match them off, so one to the other. Here we've got pension provisions as that one item that was longer than the one. So in this case, we're saying that these pension provisions are something that are long term. And we've got your share capital and how that's split. So in this case, we had 100 shares at £1 each. And then we've got this important one here, the profit and loss account. This is how much money is owed or available to be paid over. And this is where if you had any dividends taken out in that particular year, you'd expect to see the dividends shown at this point. So you always need to make sure that, again, this is a positive figure before you look at raising any dividends, and that's your profit and loss account. The final figure within a financial statement is that income statement, so your profit and loss account, for the year. So this is not as at the moment, this is for the year ended. So this is for the full period. So 1st of April all the way up to the 31st of March. And basically this is all of your income versus your expense in a detailed format. So here we're not just showing our turnover, our total turnover, but we're going to be showing our cost of sales split into all these different categories. And we also have comparatives, so we can look from one to the other. So here we can see our purchases have gone up, but at the same time our income's gone up. And then we can see our direct wages have gone up quite significantly. And it's those sort of things you're looking at where you want to make sure you're confident that they're correct. Maybe you've got some selling distribution costs as well. So the idea of having these different categories of cost of sales, selling, distribution and admin, well, cost of sales is designed to be a cost to the business, which is fully representative of what income you've had. The idea is that every time you sell another item, you're going to incur another cost of sale. Now that could be some more wages because you've had to sell, you're going to employ someone maybe to bring that particular item to sale, or it could be that you've actually buying and selling items. And if that's the case, you've had to purchase that item in the first case and then you've gone to sell it. So your cost of sale should always be in correlation to one another. So that's why we split those costs in there. If there's anything that's related to you actually having to physically sell an item, and that every time that you buy and sell that item, you're going to increase your costs, they should go in the cost of sales element. Selling and distribution costs is that similar sort of aspect, but it's just trying to take it away from your cost of sales. So you can see that those items are a little bit more different, and it gives you more control over making sure that you're not and getting some kind of information on if you're overpaying. So in this case, our packaging materials have gone down quite significantly. So that's a real good positive. Even though we've massively increased our sales figure, we were able to reduce our packaging. So what would have probably happened is this time last year, as business advisors, we would explain that that seems to be going up high. Is there anything we can do about it? And that's where, in this case, there was a conversation and we've been able to reduce that figure, reduce that packaging materials by using some form of additional method so that we can save on that going forward. And then you have what's called the administration expenses. Now, the reason that these expenses are split from the other two is because these costs have no bearing on how much sales that you've made. The idea is that it doesn't matter if you sell £1 or £100,000 or 1 million, as we're almost at here, then it doesn't really matter because this figure here is all going to be representing your actual figures that are administration costs. So you can just have that one cost and it will still be okay. So administration costs are, it doesn't matter if you have that £1 or 1 million, you're still going to incur these costs anyway. So we keep these costs separate for you so that you can see that basically this is your run rate. You have to at least clear this figure here, this total your administration costs, before you can start making profit. And that's all based on your gross profit. Now, gross profit versus operating profit or your net profit is basically your gross profit is a percentage. So every time you make a sale of something, you expect to get, say, 30% profit. And the more sales you make, the bigger that gross profit's going to be. Well, that administration cost will most of the time be static. So that's your aim. You need to clear that figure before you then start making profit. And that means that every time you sell an item, say you get 30% back, you need to figure out that basically you need to sell X amount, which is going to result into 30%, which will then clear your admin, which will then start giving you a profit figure. And we normally call that your burn or your run rate. The rest of these costs then in your administration are all going to be based around items where you feel are relevant to your business. And again, we have that comparative. So in this case, we've got more wages and expenses, but this is more your management costs. So you're always going to incur these no matter how much you sell. Your director salaries, you've got accountancy fees, you've got legal and professional, you've got cleaning, you've got rates and water. And remember, you've got that comparative. So straight away for me, I'd be questioning, well, why has that rent gone down? Light, heat and power have gone up. So one of our questions will be, well, is there any way we can reduce that figure for you? Then there's the looking at things like credit card machines, bank charges. There's those depreciation, so they should resemble what was in that last note that we looked at. And then we've got general insurance, repairs and renewals, which has dropped hugely from one year to the next, and those figures that are going there. And this is what we're looking at. We're looking at comparatives from one to the next. So now we've got our total turnover at the top. We then less any cost of sales, so anything that's been generated that is a direct responsibility of those income that we've received, gives you what's called our gross profit. We then take away, in this case, any selling and distribution costs, and we take away any of our administration, so our fixed costs, and that gives us what profit we made in the year. We then take any tax implications in this, and because in this particular one we had tax losses last year against taxes that come in, we've just got a small little repayment that we expect to see, or an adjustment from last year, whatever it's going to be, or that will be a large figure depending on if you need to pay a tax bill. That then gives you that 22,754, which is important because that 22,754 is what gets shown in your profit and loss account against the profit and loss that was brought forward. And again, we may have to see some dividends to be paid against it. So that profit and loss account should be something that you should feel before you go in there as what to expect. And then when you look at it, you just compare against not only previous year, but your expected results as well. And that's where you can then have that conversations with your accountants or business advisors to either temper why your expectations haven't been met or why they've been exceeded. And that's going to help you justify and understand and have confidence in these figures. So you've looked at these figures, you understand them, you're now going to go sign them based on the fact that they feel right, that your income less your expenses is what you're expecting, that those administration costs is what you expected to pay, that your balance sheet was showing a true and fair reflection of what your business was at that point. Did you have that amount of money in the bank account, or have these figures come from somewhere you're not aware of? They're the sort of things you'll be looking at. They're the sort of things you're going to want to get confidence in before you sign that dotted line. Because what we're going to see next is how these figures then fully represent how your tax figure's been generated. Well, that's going to be important to you, isn't it? But before you make sure your tax figures are right, make sure the base records are right first, so your accounts. And if the accounts, make sure their base records are right, which are going to be your bookkeeping. So there's a whole route to take and a whole kind of journey into what that final tax figure is going to be. But take it step by step by step. Get confidence in each step and make sure you're happy with it. Hopefully you found this video useful. My idea here is to give you an insight of what a set of accounts should look like, how you can get confidence in them, and how you can be confident in signing them and knowing that they're right for you as your business. Financial statements are so important for small businesses. That's basically what we've made, why we're in business in the first place, is to try and hopefully make that profit figure and make as much profit as we possibly can. So understanding how that figure is generated and what is going to be shown on those final set of accounts is really crucial. My name's been Aaron Patrick. It's been an absolute pleasure to do this video for you. If you need any more help like this, don't forget hello@boffix.com, or any of us at Boffix will be able to help you understand your financial statements the way it should be. And if you like this video, don't forget to like, subscribe, make sure you leave a comment as well on any other video topics you want us to cover. And that way we can make sure that we get the content to you, because that's what's important. Our goal is to make sure you as a small business gets the content that you need. Again, my name's been Aaron Patrick. It's been a pleasure to do this video, and I will see you on the next video. Bye for now.
I told him I can be a fighter if you want. I'll be there to catch you if you fall. I can make it brighter when it starts. I told him I would do it all for you, and I know you do it for me too. I can be a fighter if you want, I can be a fighter. I can be a fighter if you want. I can be a fighter if you want. it's real, cause I can get him out of my head. I don't care what we do, everything's feeling new. Even if we stay in bed, my heart is saying yeah, 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 yeah. You know I want him, nah, 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 nah. My heart is saying yeah, 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 yeah.
Hello and thank you for watching that video. What you may not know is this channel that you've watched this video from is part of a wider group. That wider group is called Apple Core Production, and the 3 channels that we have involved are as follows: Aaron Patrick the QuickBooks Chap, Boffix Tax Tip. Finally, we have Apple Core Live and Geeky. All the links and everything are down below in the description, but it really means a lot to us if you can go and give a like to the other channels as well.